Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 925A, and today's date is March 22nd, 2016, and the title of the episode is Bubbles Are About to Pop as Smart Money Leaves the Market. Let's get right into the economic collapse financial news. Now, as we can see, the market really didn't go anywhere today, and we're seeing this in the last couple of days. We see gold has shot up a little bit. And at this point, we're looking at the economic indicators, and I would say 99.999% of them are pointing to a contraction of the economy. And as time goes on, we are noticing that things are just getting worse. They're not getting better. Nothing's improving here. I know everyone believes out there that everything is just going to switch around and we're going to see happy days, but it's not happening. We see the economy falling apart. The government, the central bankers, are trying to convince the population, the world, that everything is okay. But we know better. We know that it isn't getting any better. When we look at U.S. Manufacturing PMI, well, this has missed by most since 2013. And it is at near multi-year lows at 51.4. They were expecting 51.9, and it just didn't happen. We see wholesale inventories at record highs, and we're not seeing any type of recovery whatsoever. Manufacturing is continually declining. The Baltic Dry Index had no change. It is holding steady at 398, which is very, very low. This is the raw material that manufacturers use to create goods. And we're seeing in retail that retail is continually contracting. It's not improving. It's not getting better. Everything didn't switch to the online sales. That is a myth. Maybe in a strong, healthy economy, maybe they can make that case, but this is an economy that is contracting, that is collapsing, and the people are nervous. They're afraid. They're worried about their jobs. I'm getting emails from a lot of people saying there are rumors in their companies that more layoffs are coming down the line. And we're starting to see that bubbles are starting to pop. We talked about the auto loan subprime bubble, and we're starting to see that the number of delinquencies on those loans, they are up by 5.16%, the highest level in 20 years. And we're starting to see that a number of people, they cannot get traditional loans for cars anymore. They lack the verifiable income to qualify for these loans. They don't have the credit scores. But we see they're just handing out these loans left and right to get anyone they possibly can into the bubble. We saw this in the real estate bubble. Comptroller of the currency, Thomas Curry, said, "What's happening in the auto loan market reminds me of what happened in the mortgage-backed securities in the run-up to the housing crisis." These loans are being defaulted on in growing numbers. People who can't swing a mainline loan at 3 to 4% interest are having trouble keeping up with the loans that have interest rates twice as high. And we're starting to see that this entire system is starting to fall apart. And it's getting worse as time goes on. Now, what's very interesting is that the market has been hovering, not really moving up dramatically, not really coming down dramatically, but just keeping it at this high right now. And in the last 5 weeks, we saw the smart money leaving the markets. Then it was 6 weeks. Now we see we're up to 8 weeks where the market has rose by 1.1% and an unprecedented number of investors are pulling their money out of the markets. Bank of America's hedge funds, institutional and private clients have sold stocks for a whopping 8 consecutive weeks as they continually keep this market propped up. Bank of America clients were net sellers of U.S. stocks for the 8th consecutive week in the amount of $1.4 billion, suggesting clients still doubt the sustainability of the rally. This is the longest selling streak since October-December 2010. Now, we know the central bank, at this point, they don't know which direction to go in. They're talking about negative interest rates. They're talking about raising the interest rates. They're doing whatever they possibly can to keep the market propped up for a little while longer because they don't want to be blamed for this. They want to blame another group, another entity, another country. And we're hearing rumblings about taking these funds from the central bank, which they create out of thin air, and supplying them to the people, called helicopter money. And what they want to do is they want to stimulate the economy. They want people to take this money and spend it in retail. Now, let's think about this for a second. We know there are other countries that have done this. The Weimar Republic. Well, they did this. They continually printed. They gave it to the people. They wanted them to spend it in the market. And what happened? The value of their currency went down. And we saw hyperinflation. Now, the big question about this is who decides who gets the money? Who is going to get it? Well, you know most likely the everyday person is not going to receive much of any. Just like we saw with quantitative easing and everything else, the banks never went ahead and loaned them people these funds. They put it back into the stock market to pump up the stock market. Most Americans don't realize this, but the primary reason why stocks are doing better in the U.S. than in the rest of the world is because of also stock buybacks, where they're giving this free money to corporations and they're buying back their stocks. Banks are receiving this free money and they're instructed to put it into the stock market to pump it up. And according to Wolf Richter, corporations spent more than $500 billion buying back their own stocks over the past 12 months. Now, when corporations buy back their stocks, that means they are slowly liquidating themselves. Instead of pouring money into new good ideas, they're just returning money to the investors. Corporate executives, they love stock buybacks because it increases the value of their stock, and big investors love them too because they love to see the value of their stock holdings rise. But in the long run, what does this do? Well, it doesn't help the situation. It puts money into those people's pockets, and the rest of the people are being laid off because they need the funds to buy back the stocks. And this is why we see layoffs in corporations right now. So we have two things happening at this point. They're keeping the market up. They're thinking about printing a lot more currency. Who are they going to give it to? We don't know at this point. But it's going to devalue the currency. And we're going to see hyperinflation. And when the rest of the world sees this, they're going to say, hey, wait a minute. We better start getting rid of the reserves, the dollar in our reserves, and maybe we should take on a different currency. And they'll be dumping the dollars. Those will also flow back to the United States, which will then devalue the dollar. And we'll see hyperinflation. So when we look at this situation, the situation is just going to get worse. It's not going to get any better. The economic indicators are completely falling apart. The central bank is propping up the system until they get the blame on someone else. But things all around them are starting to fall apart. Moody's has just put Deutsche Bank on review for downgrade, citing execution challenges in its new strategic plan. Now, back in May, June of 2008, S&P downgrades major U.S. banks included Merrill, Lehman, Morgan Stanley, all after the banks raised additional equity, capital, sparking an incredible bounce back in, I think it was around April, May of 2008, everything started to fall apart. Well, we're at the same point with Deutsche Bank. And it only took another, 6 months after that until the entire system fell apart. So at this point, everyone needs to realize that they're holding the system together not to help you, not to help the people in all different countries, to help themselves. This is why the smart money's leaving. This is why they're keeping the market propped up. They're trying to get the retail investor in, which most of them are not doing at this point. They're trying to get their money out of the system. They're trying to convince everyone to spend their money, which everyone is very nervous about doing because they know the economy is falling apart. And we're going to see there's going to be a certain point in time. Now, what's exactly that point in time? We don't know. Where the entire system is just going to completely implode. They won't be able to control it anymore. The real economic indicators will take over. Their illusionary numbers will not make any sense whatsoever. And everyone will be running for the exits. People who are not awake will not know what happened. They will be nervous. We'll see corporations come out. There'll be mass layoffs all over the place, just like we saw it in 2008. But this time it will be much worse. And people are going to get very nervous at this point. They're going to feel scared. They're going to wonder what just happened. Where do I find another job? How do I make my income? Why isn't the government doing anything? Why are there police, DHS on the streets? And people will be making runs to the market. People will be trying to get supplies. And this is why you need to be prepared for what is coming. You need to get your affairs in order at this point. We see around the world the situation is getting worse. We see things are really starting to pick up in Eastern Europe and Middle East and the Pacific. And we see at this point, there's not that much time left before this entire system completely falls apart. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.